Good morning, everybody. This is the Oracle of Origins, Randy Rintala, coming to you live from my home. And I have a special guest today, Miss Cindy Gerrard, who is the Vice President of Mortgage for Fifth Third Bank. Welcome, Cindy.
Thank you for having me.
Yes. Now, everybody in today's market, being that lending has been a hurdle in a lot of cases that people were struck with when interest rates really exploded. How long has it been since they went from those times we're in the threes to where we are now?
It's been approximately about 2 years since the very bottom of the market.
Wow, 2 years. It seems like it was 2 years, you're right. Yeah.
Yep.
So from that point to when did you see people finally have to adjust and come to the realization that the rates were not going to come back to those levels?
I feel like probably the middle of last year was, in 2023, was when people kind of started to realize that the market had changed permanently and that it wasn't going to be something where we were going to see rates just stay low. But I think that when they started to see the rates go up and started to realize that there was actually a new norm,
Correct.
So.
Yeah, because that's what's happened is I believe, and you can let me know on this, that we are a spoiled public from the standpoint that everybody thought that these rates were going to last forever and they can't believe it. They'll come back down. But doesn't it take an anomaly, almost a bad situation for rates to get to those levels?
So yes. So the reason why the rates were, suppressed so low is because a lot of things, but mostly the world economy. When COVID happened and literally the world shut down, not just the United States, but other markets, because a lot of our monies that we borrow against and stuff like that are actually tied to other countries too. And so everybody went down to borrowing at zero. So the governments can borrow at zero. So the banks can lend significantly less, right? Mm-hmm. So
because you make up a really good point, because I think people need to understand how does lending work when things happen like that? From, I guess the word that people can associate it with is prime. Can you get into that?
Yes. Okay. So the base borrowing rate for banks is what's called prime. Okay, so prime rate, you can look it up, it's Wall Street Journal prime. During the COVID pandemic, when the economy they were trying to not have the economy shut down completely, right? That's where PPP money came in, stuff like that. So at that time, the borrowing rate for prime was zero, literally zero, right?
Well, think about that. So zero. Now, can it get any less than zero?
Can't get any less than zero.
Okay,
can't go down, can't go negative. Okay, so borrowing was actually at zero. So if prime is at zero, then the rates are at 2.5. So the bank still has their 2.5.
So let's stop there. So
yes.
let's because just from a layman's standpoint,
yes.
It's easy math.
So
it's prime plus the bank's margin. Is that about right?
Yes.
And who determines that mortgage the margin with the banks?
The lender does.
Just the lender itself?
Yes. Now the government has monies too that things are tied to that are different, that are government-backed monies. But we'll kind of maybe get into the weeds. But so the interest rates were superficially put down to the pandemic so that the economy literally would not shut down, right? So, and that obviously our economy, the United States economy, affects other economies, right?
Absolutely.
Right? Because we're America.
Yeah.
And so, so when you have, stimulation, rates go down to stimulate the economy.
Yes.
Right? Mm-hmm. So that was to kind of keep everything kind of moving and us living in Florida, we're so blessed to have the opportunity where we weren't really shut down like other places in the
Correct.
United States. And so a lot of people wanted to still live their lives. And so they wound up coming here. So that's kind of when the Florida market kind of really got a humongous bump.
Oh, absolutely.
So
now, when's the last time you saw this? Was this more towards when the financial crisis of 2006 to 2010? Is that the last time we saw something like this happen, or was there a time in between?
So the last time where the market was, it's totally different stimulation, right?
Yeah.
So what happened back then is that the regulations of banks got real loose. Okay, so things got real. Different lenders came into the market, different banks came into the market. For example, Countrywide, you had these larger institutions originating mortgages with a lot less due diligence.
So basically, that's what started the reason why, similar to what happened to COVID. So we had an abuse of the financial system, right? And then we've had COVID, which again, the abuse of the financial system caused.
But those rates
are
were
a
low.
different market.
The rates were
No,
low,
no,
but
no,
it
they
just
were
made money
regular.
very easy to obtain.
But once it was starting to settle, that's when the rates had to drop to stimulate the housing market once again, right? So where were we at those levels? Do you remember that 2000, maybe 11, 12, 13, 14? Was
Yes.
that about the same range where we were sitting in the maybe 3s and 4s, or where were we?
We're probably more like in the 4 or 5s then.
Okay.
Yeah, we're probably in the 4 or 5s then. We've never been as well. I've been originating. Let me take that back. Maybe not never, but I've been originating for now 23 years.
Well,
Okay?
good, because we're talking
Yeah.
about the same language here, because I've been in real estate for 20 years, and
Yes.
that's where I really want to focus. And I think most people would understand that.
Yes.
Because
But when we had money in the 2s and 3s, it was mind blowing.
okay, so that is beyond the norm, even
Oh,
on
yeah, yes.
a
Well,
stimulation standpoint.
I
That's-
would say you wouldn't see anything like that ever again unless we had something like the Great Depression.
Yeah.
You're talking about a worlding pandemic where economies literally are shutting down because people can't work and people are getting sick and people are literally living in fear.
Yeah.
So you have that, scared to spend money, scared to go outside, so you have the fear. That is totally different. But do I feel that we'll ever be back in the 2s and 3s? It would have to be something as a catastrophe,
Yeah.
like the pandemic, or something like the Great Depression,
Yeah.
where
Yeah,
I
it
feel
doesn't
like
help
I feel like
anybody
our
really at the end of the
society
day.
and the world is more advanced than the 1920s. But it's just something that happened that kind of needed to keep things kind of moving.
Yeah.
But do I foresee money that inexpensive ever again? I honestly, personally do not. Not in where that you and I feel that you and I will see.
Yeah,
But that's the thing, is like, do we need a catastrophe?
No, it doesn't benefit anyone.
It doesn't. It's just
So that's the big thing that we're trying to get out there for folks, because now I think that's exactly what's happened is people have come to the realization that these rates are the norm. So
Yes.
now you have to adjust your lifestyle to do other things if you want to purchase a home. Because when they were at those low rates, of course you were able to purchase higher than you normally would have, and
Yes.
people took advantage of that. And
Yes.
people are still locked in, because that's going to be something else we're going to speak of. Because what we're finding is that we're finding a lot of buyers who are locked into these 2.5% rates, 3% rates. For them to buy another home, they're going to give that up. So, what are you hearing from buyers? What are they juggling, or what is their stance on that?
So what I'm hearing from buyers, the people, things change, right? We don't live in a linear world. So people have to move for work, or
Absolutely, yes.
they have to get a bigger home to accommodate their family, and people want to retire. So one thing about all these low rate houses and mortgages that people have, a lot of those people also have equity.
Yeah.
So that equity is actually the ability to kind of take that equity and put it towards the new home.
Great
and,
point.
And so that even though their interest rate may be higher, it isn't. But you're talking.
Because you're able to put down more money.
You're able to put down more
so
money.
it kind of balances that out.
People
yeah.
could even get a 15-year term. It just, things are not linear. It's things just don't always stay the same. And, people are going to say, well, I can't get out of my house for 30 years. Nobody stays in a house for 30 years.
Correct.
Maybe my parents. Maybe my,
Yeah.
maybe my parents.
Old school they did. I don't think today's buyer is. That's exactly right.
Because you're talking about people that are in the 70s.
Yeah, and I believe that statistic, when we looked it up here in this past year, it was, I believe, 5 to 7 years is the average time a home buyer stays in a home. So it's just a matter of time.
So
that's a good point, though, and how you can equalize. So that everyone needs to remember that is that don't just think of it from a rate standpoint. Look at your circumstance. Look at the equity that could potentially bring down what you're going to be borrowing, and then that would be the equalizer. It sounds like. So yeah, that's a great point for that. And the fact that we're seeing it in our business here at Watersound Origins, we're continuing to sell. And not everybody's coming in with cash. So they've come to the realization, because now they've also recognized the lifestyle. Some things are worth moving, and some things you can't control, similar to what you were saying.
Well, but this is the thing, lifestyle is everything. Yeah. Convenience, safety, the ability
Absolutely.
to, that is, amenities make quality of life higher for people.
Yeah.
Right? And so when you have that, and, people also like to buy new.
Yes.
People like to buy new, and I've done it.
We love that.
And but this is the thing, and I've done that. And our home that we had before, I'll just never forget, being in the bed and looking up at the crown molding and being like, I picked that. And then my husband's like, no, I picked that. And I'm like, oh, okay.
But you're right.
But
You did pick that.
But there's nothing like,
Yeah.
Kind of having
putting your fingerprint on
putting
the
your
home.
fingerprint
there's something
on it.
special about that.
I mean, you can't even. There's.
Yeah.
There's.
You can't really quantify that.
You can't quantify it.
And that's the thing. We've seen that even here. That's the feedback that a lot of people get. Because I'm the same way. I mean, hell, I don't even buy a used car. And maybe I'm that sucker, but I don't care. I mean, I'll do that because I know what I'm getting.
Yes.
In comparison to some, I guess inheriting the unknowns.
Yes.
Or a lot of extra cost when it comes to the rehab side of things. So
let's if we may, let's talk about that. So like the thing about it too, though, is that pre-owned too is not necessarily bad. It's in a neighborhood like Origins, where you have high quality builders, you kind of also do know what you're getting to as well, right? Because a 3 or 4 year old home. But I mean, does anything replace like you said, putting the fingerprint on a home? I mean.
And that's what we've gotten into here recently. We've had other, discussions in reference to the ability that you can do a lot more of customizations and modifications to plans. So things have changed, and that's what we were getting into, evolving. You've got to be able to evolve, and that's the one thing with the lending market. That leads to what's out there right now. I mean, what has the lending market evolved with the times? Would you guys consider this slower times? What's the term? Moderate? What market are we in right now from a lending standpoint?
I would say probably moderate is probably a good word for it.
Good, because that's how we view the current sales market.
It's moderate. I mean, it's things don't do this. You can't do this forever. Because if you do this forever, then there has to be some type of
some leveling off.
Leveling off.
Correct.
Now, one thing I've noticed that's very common of people that I'm locking in loans right now, the average consumer still thinks that money's at a certain interest rate. They're like, oh, rates are 8. And I'm like, rates are not at 8. So one thing that has evolved in banking is that we use our portfolio monies for lending versus using government monies for lending. So the bank has
explain that further, because a lot of people don't realize that word portfolio, that there are potential options.
Yes.
And it's per bank, I'm assuming.
It is per bank, right? Mm-hmm. So it is per bank. And so you have portfolio monies, and then you have government-backed monies, okay? And so it's literally 2 buckets.
Okay.
So I can lend you my own money, or I got to lend you money that the government gives me that I have to pay a premium for, okay? Now when I say premium, I'm not talking percentages, but quarter still cost more, right? So with portfolio monies, you're actually allowed to kind of discern, the bank is able to discern what the cost is of those money. So right now, you would say, okay, a 30-year fixed is 7.5%, okay?
And on a what? On a portfolio or?
We'll just say 30-year fixed, 7, we'll just say 7.5%.
Okay.
Okay? If I have portfolio money, I have a really unique product. It's called a 15-year ARM. It's amortized over 30, and it's fixed for the first 15 years. Okay? That money is at 6.
Oh, that's huge.
So do you see what I'm saying? So having, working with somebody that has the ability to portfolio monies, which is usually a larger institution. Okay?
Yeah.
And the reason why, just because they have more deposits. It's just that simple. So they have more money to lend, and they can regulate that. So people are, choosing these, like you said, people don't stay in home for 30 years,
Correct.
okay? The average loan, less than 90% of all loans stay more than 9 years.
Wow.
So the 30-year fix was actually designed after World War II for people to get into homes and have home ownership, okay? I have a realtor friend. He's like, that's your grandmama's loan, because people did back then. They used to stay in a home for that amount of time. They stayed in a little ranch,
Sure.
But market has changed, and a lot of the consumers that we work with in our area also are people where their income isn't the same for the next 20 years. Usually, they make more money, right? And so. 2 things they could do with that: buy a bigger home if they wanted to accommodate their family, or take that additional money and pay off their principal off sooner.
Sure.
Right? So they can, they can discern. But portfolio money really does allow the bank to offer the consumer a better option than traditional products. But a 15-year ARM, I've not had one person say, I don't want that product. They're like, oh yeah, 15 years from now, It's going to be totally different. And they say, if rates do go down, then I'll refinance. But if they don't,
So you can still refinance.
yeah, you could
portfolio
refinance.
loan.
And there's something that is really cool about certain portfolio products is, say that you have somebody moving from Texas to Origins, right? And they're like, I want to buy this $2 million house. But I haven't sold my house in Texas and I have a lot of money, but I don't want to, I'm like, okay, one thing that you can do, you still have to put money down for the house. But let's say in 6 months you plan to sell your home in Texas. Okay. And your equity's $500,000. So you're buying a $2 million house, you get a loan for $1.6 million. Okay. In 6 months from now, you sell your house. You're like, I want to put $500,000 towards this house. You can put that $500,000 towards this house. For $300, you can do what's called a recast, like the cast on your arm, a recast. Okay. The recast actually allows you to take that principal, put it towards a loan of that 1.6, and then you have a loan for 1.1, and you're paying it 1.1. You're not paying it 1.6.
Wow. Yes, that's what I'm talking about. So these are the types of loans and things that are out there. So do you consider that creative financing, or is that just a specific type of loan that's categorized in a certain...
It is educating the client. It's like, okay, this is, well, what do I do about this? And it's educating the client that people sometimes don't take the extra step to explain to the customer, like, what can really help them in their certain scenarios. So, like,
when
obviously...
you mean people, though, you're talking about lenders.
No, I'm talking about the customer. But lenders...
Yeah, the lender's not explaining. That's what I mean.
Well, I'm just saying that there's, if you do what's in the educating the customer in the best interest, but like obviously if somebody is moving from Texas and they already sold their house, that doesn't apply to them.
Sure.
So you wouldn't tell them about it. But it's really listening to the borrower and seeing from them, we call them the borrower, so the client borrower is listening to them and kind of listen to like what their plans are, right? So like if this guy is like, hey, I'm retiring in 2 years, want to buy a house, but this is what's going on. I will listen to him tell me. And then he's like, well, you know what? My wife, the kids are out of the house. My wife is ready to be in Florida. I got to get her at the home now, right? So then it's like, okay, but in 2 years, when you do sell, this is what you'll do. You'll do what's called a recast, and it's like $300 and there's no prepayment penalty. See, if you got to take all that money, say if you make that much money, you want to put it toward this house, you could pay it off. There's no prepayment penalty on
Nice.
it. You know what I'm saying? So like it's really listening to them and asking them the extra questions like, okay, how long do you think that you're going to keep this mortgage? The guy might say to me, hey, I'm retiring and then I'm going to get my deferred comp and I want to make double payments to it. And so like it's really just kind of asking them, like, not just like where you are today, like, let me help you pick the right product so that you can have the right product for now and for the future. And
that's what people want people to understand. This is why I invited Cindy, is because of her knowledge. There's so much you just don't know, and I don't pretend to know, because at the end of the day, it's called competitive advantage. Do what you do best. And so what you do best. Yes. And so what I do is tend to give my information or my clients' information, or give your information to clients, and hope that they get educated on that. Because I know if they call you, they would. And with your bank, you're one of your bank's a really strong bank, so you're going to have probably more programs than the average bank. Is that about right?
That is. We're one of the most well capitalized banks. What well capitalized means? Assets. We have our balance sheet's heavy on money. And that's Fifth Third Bank, right? Yes. Yep. And it's a national bank. It's a national bank. Yes. And so what do you think is the number one thing buyers should do? Because I will say this, especially in new construction, I had 2 sales this week in similar situations where they both actually had to sell. Yes. I didn't know this. And these are the types of things that I would love to just have any information so we could say, hey, wait a minute, there's something out there. Because there's certain things that all these buyers, now again, this goes back to people wanting to purchase homes. They're always going to want to purchase homes. That's the American dream. Yes. And as we said, people's it's even more American evolve. Dream here in Florida. Absolutely. And people work their whole lives to live where we live. Yeah. It is like their dream. I mean, I have talked to people that were firefighters at 9/11 to wealthy executives and everything in between. It's like they come here for the quality of life, the amenities that we have, the safety, the beach, all the lifestyle. Yeah, and folks, we're talking about the South Walton lifestyle because, Florida's different all over. Florida's different all over. You've not been here, or I'm sure you've heard, I'm sure there's been maybe a vacation, but at the end of the day,
it's amazing still to hear people talk the way they do about this area. I mean, they're just
It's a dream come true.
Yeah, they're amazed.
It's a dream come true, and we have the second best schools in the whole entire state.
Absolutely, and that's huge.
It's huge. So,
and that goes back to the diversity of what we have here at Origins. So there's families, there's empty nesters, there's retirees. Everybody's in a different financial position, and that's why having the lending background and having the experience of lenders like yourself, it's huge benefit. And so our builders are working with our lenders now to come up with programs. So I want everyone to always check in with us, because you never know what's the next incentive out there, because there's going to be quite a few incentives as we continue to sell through the neighborhood. So we appreciate that. So Cindy, what do you think about the future? What is 2024 going into 2025? I'm hearing all kinds of different things. And after you answer this, I'm going to give you my take from the real estate standpoint of what 2025 is looking like. Now, I know we're in an election year, and I don't like to get into all that, but at the end of the day, it matters. That stuff
absolutely matters.
Let's keep it real, folks. It matters.
It matters.
So what are you thinking for the remaining of 2024 going into 2025? What's the pulse of the lending market?
Okay, so I'm not an economist, and I always say I got a D in economics at Auburn. So I am not an economist, but I do feel that we're going to see a little bit of reduction in rate, maybe at the fourth quarter of this year, but it will not be significant.
Not enough to wait it out.
It's
right?
It's not enough, because if you do the math, and the 0.5% difference is, I mean, it's literally like nothing. It's not worth the wait. And so
yeah, that's good though, because that brings up another subject. I have heard people saying they're waiting for the rates to come down, and they're
do the math.
Yeah, it's just not.
Do the
worth
math.
It. Don't miss out on an opportunity
Yeah.
or life, because life. Hey, listen, we all learned this past week, life can change in an instant, right? With our national situation that we're dealing with President Trump. So I think everyone's been reminded of these things, and on a national level, because I mean, life can be, the good, the bad, and the ugly. With life, we got to grasp every situation and take advantage of opportunities that we feel that our timing is right for now. Don't wait, and don't let things like the rates and all this change your decision when it comes to opportunity.
Well, and this is the thing, timing and opportunity are different for everyone. But I wouldn't wait an opportunity for a better situation, I feel, for myself and my family, ever, right? You would instantly take action on what you feel is best for you and your family. That is not something where you can say, all these external factors are noise, right? You get back to the very, very basics, like, is this the best for me and my family? And if it is, the answer is yes. All this other stuff is like noise. Would you miss an opportunity to save $300 a month? Probably not.
Yeah.
You know what I mean? $300 a month is like not even grocery bill for 2 weeks, right? For a family. So I feel that we're going to see a little bit of reduction, maybe in the fourth quarter. I feel like that, but I feel it's going to be pretty steady. And I think there's a lot of people, due to like election year, it is traditionally where people don't necessarily make moves, right? They kind of hold, right? Mm-hmm. So when people hold, that creates opportunity for others,
Absolutely.
Right?
And that's what we're looking at from the real estate standpoint. We think 2025 is going to be a really big year, even though we've been fantastic in 2024. I mean, people are shocked how we are selling, and we should. We are the most popular subdivision in all of South Walton. We will continue to be. No one can compete with what Origins has out here, so we're very blessed with that. But yeah, our outlook is going to be high for 2025. So we appreciate you coming in and giving us just the education.
You're welcome. I'm happy to be here.
Oh, well, we're going to do it again, because I know that your knowledge is to the, you're a true expert on what you do, and that's what we feel like we are here.
Thank you.
And especially the fact that I've already seen how much work you've done for my clients, and I love the fact that there's so much I'm still learning, even though today, learning.
I know you love to learn. I know you love to learn.
Oh, trust me, I like to have as much knowledge, because knowledge is power.
Sponge.
Yeah, and I love to give that to my clients, and I love to refer people that I know I can trust, and I can trust you. So again, guys, this is the Oracle of Origins, giving you a little bit more knowledge for yourselves, and we're really appreciative to everybody who joins us on our communications and podcasts and everything. And again, I want to thank Cindy Gerrard she is again the VP of Mortgage at Fifth Third Bank, and I'm sure we'll be seeing her again. So thank you all.